Welcome back, everybody. In the previous video, we said that if you want to use an asset, you have two options. You can buy the asset or you can lease the asset. Well, in this video, we're going to get into more detail about the leasing option. As you can tell from the title, operating versus capital leases. Now, operating and capital leases, these are the two major types of leases, so we're going to go over their different characteristics in this video. Now, one thing to mention, capital leases, you may see that as financing or financial leases in your textbook, depending on which book you are using. But financial leases, financing leases, capital leases, they all mean the same thing. So let's start off with a scenario here. Let's say there's a company and the balance sheet of the company looks like this currently. So right now they have 100, let's say these are in thousands, so they have $100,000 worth of assets, so that's the left side of the balance sheet. And then to balance out that left side, we have, or the company has, $50,000 worth of debt or liabilities and $50,000 worth of equity as its sources of capital. So now that we have this information about the balance sheet, let's figure out some solvency ratios for this company. And solvency ratios basically measure the company's ability to meet its long-term debt. So one solvency ratio that is commonly used is the debt to equity ratio. So the debt to equity ratio of this company, D over E, is going to be 50,000 over 50,000, and 50 over 50 is just 1. So the debt to equity ratio of this company with this balance sheet is 1. Now, another common solvency ratio that can be found from a balance sheet is the total debt ratio. And the total debt ratio, if you remember, it's basically the debt over the assets of a company. So right now, this company has $50,000 worth of debt, which will just represent as 50, and then the assets of the company are 100. So the total debt ratio is basically 1 over 2, or if we want it in decimals, 0.5. Now let's say in addition that the company runs into a situation where it needs to use a certain $30,000 machine that it currently doesn't have access to. And this machine is going to bring this company a lot more business, a lot more income. Well, to gain access to this $30,000 machine, the company has two options. It can buy it or it can lease it. Now, usually when companies are debating of whether buying or leasing certain assets for their business, usually those assets are fairly expensive. So let's say in this scenario that this $30,000 machine, if the company buys it, it's not going to buy it with cash. It doesn't have $30,000 of cash lying around. This $100,000 worth of assets, let's say it's mostly fixed assets that are already working in terms of bringing income for the company. So if the company does decide to buy this $30,000 machine, it's going to have to take on debt to buy it. So let's say that it decides to buy it, decides to take on the debt to buy this machine. Well, now instead of $50,000, our debt is going to be $80,000. $30,000 more added on to that previous debt figure of $50,000. And now our assets are not $100,000, but they're now $130,000. So the left side of the balance sheet grew by $30,000, the assets grew by $30,000, and the right side of the balance sheet grew by $30,000 again. More specifically, the debt or the liabilities grew by $30,000. Well, because our balance sheet changed, that means our solvency ratios are going to change as well. So let's see the implications for that. Well, notice that our debt now is 80. It's not 50 anymore. So this part of the debt to equity ratio is going to be 80. The equity is still 50,000, so we'll still keep 50 in the denominator. So 80 divided by 50 is 1.6. So that's the new debt to equity ratio. It's 1.6. And then notice how the total debt ratio changes as well, because the debt of the company is now 80. And then the assets of the company are now 130. So that would end up simplifying into 8 over 13, or if you want the decimal value, it's going to be 0.62. So notice how the solvency ratios went up. The debt to equity ratio went from 1 to 1.6, and the total debt ratio went from 0.5 to 0.62. And that's not a good thing, because you want to try to keep the solvency ratios low. The lower the solvency ratios of a company's balance sheet, the more healthy it is. And because these ratios went up, buying this asset, buying this $30,000 machine, may not be the best option for the company. So let's say we decide to lease the machine instead. What are the effects going to be? Well, if you remember, in the leasing overview video, I mentioned that when you lease an asset, you don't have to put it on your balance sheet. It stays off the book. So if we do lease the machine, our balance sheet is going to stay the same as before. So notice how it's still that $100,000 worth of assets on the left side, debt is 50, equity is 50, and then the solvency ratios are the same as they were before. The debt to equity ratio is 1, debt to asset ratio, or the total debt ratio, is 0.5. So notice how the solvency ratios didn't get worse, they stayed the same, which is great. And then all that changes is, as long as this machine is used for business, we're just going to have a leasing, or sometimes it's called a rental expense, periodically on the income statement, right? The lease payments that we're going to make, we can deduct for tax purposes as long as this machine is used for business. And then we're also going to have to disclose in the notes to the financial statements that we are leasing this machine. But as far as our balance sheet, it stays the same. So when investors look at the balance sheet, the solvency ratios are going to stay the same, and we're going to gain access to using this machine because we are just leasing it, which seems like a pretty good scenario for the company. We have access now to this new $30,000 machine that's going to bring us extra income, and we kept our balance sheet the same. We kept that machine off our books, so our solvency ratios are still pretty good. So intuitively, you would think that the company would probably take on the leasing option in this particular scenario. Now we'll come back to that specific scenario about the machine, but before we do so, I want to get a little bit general again. I want to go back to talking about the natural implications of when you're buying an asset versus when you are leasing one. So when you're buying an asset, and one that you're going to be using in your business that's going to bring a lot of value to your business, usually you're buying it for the long term, and you're going to be using up most of its value. And at the end, usually it's salvage value because you used up most of its value throughout its life. It's going to be close to zero, or it's going to be zero. It's basically going to be worthless, and then you got to figure out what other machine or other assets to buy long-term for your business in order for your company to grow. And to get more specific with these 2 points here, taking an asset, using up most of its value, and then its salvage value is equal to zero, basically means that we fully amortize that asset over its useful life. Now, in contrast, when we look at the other option, leasing an asset, we naturally think of leasing or renting something for a short term, for a short period of time, because we're not going to be using its full value. We're just going to be borrowing it from an owner for a certain period of time and then paying that owner a certain fee to use it. So we're only going to use up some of its value. So after we are done leasing the asset, we're going to return the asset to the owner, and the salvage value is not going to be zero. Obviously, the owner is going to want an asset that still has some value. And to get a bit more technical, basically the asset is only partially amortized because we're only using it for a short term relative to its useful life. So these here are the natural or the general implications of when we are buying an asset versus when we're leasing it. Usually, when someone buys an asset, they're usually buying it for the long term. When they're leasing an asset, they're usually renting it or leasing it for a short period of time. So now let's go back to our scenario before with the machine that costs $30,000. And let's say that that machine has a useful life of 5 years. So after 5 years, it's basically going to be worthless, and you're going to have to buy or lease a new machine for your company. So the machine has a useful life of 5 years, and we decide that we want to lease the machine. We don't want to buy it because, as we showed, the balance sheet, the solvency ratios got a lot worse, and we want to keep our balance sheet as it is. We want to keep those solvency ratios down. So we decide we're going to lease the asset. We're going to keep it off our books. And when we lease it, we're going to lease it for its entire useful life. So we're going to lease it for 5 years. Well, that's actually kind of weird because we are leasing the asset for its entire useful life. So someone owns this machine, they're not using it at all, they're going to lease it to us for 5 years, its entire useful life. And then once the lease is complete, we're going to return that machine, which has a value of 0. Its useful life is only 5 years, so at the end its salvage value is 0. We're going to return it to the owner when it has a value of 0. So the question we have to ask ourselves is, who really owned the machine? Was it the owner who leased the machine to the company? Or was it the company that really, quote-unquote, owned the machine? Well, if we judge this question just by the use of the machine, then the company was the one who owned the machine. And here's the real issue with that scenario. So the company leased this machine, but it used up the machine for a long period of time relative to its useful life, basically for its entire useful life, not for a short period of time. So it used up all of its value, not just some of its value, and then at the end, the salvage value of the machine was 0. It wasn't just partially amortized. And because this company was able to classify it as a lease, they were able to keep it off their balance sheet, even though the scenario didn't match any of the leasing implications. It actually matched all of the buying implications. So is that ethical? Well, unfortunately for the company, the government says it's not ethical. The government keeps these perspectives right here. Basically, they feel that when someone buys an asset, they're buying it for the long term. And when they rent an asset or they lease an asset, they're going to lease it for the short term. And from the government's perspective, the only reason why a company would want to lease an asset for a long period of time and use up all of its value and then have the asset be worthless once it's returned to the owner is because the company wants to keep the asset off the balance sheet. And that can be misleading because when investors come and look at a company's balance sheet, they're not going to see this asset on the balance sheet, and they're not going to see the debt associated with it either. But in reality, because the company is using the asset for most of its useful life, they really do own the machine. And the government says that that machine should go on the balance sheet. So what the government does to fix this issue is it classifies leases into one of two categories. it classifies it as an operating lease or as a capital or financing lease. So a few characteristics of an operating lease, I like to think about it as a legitimate or a legit lease. And it takes on the characteristics of a legitimate lease that we've been going over before. So it's a short-term rental. The lessor is responsible for the maintenance of the asset, and the lessor also receives the asset at the end of the term when the salvage value is not equal to 0, so the asset is only partially amortized. And there's other characteristics like the lessee can cancel the contract. But perhaps the most important characteristic is that the government allows the lessee to keep the asset off the balance sheet if it's classified as an operating lease. And because of this off-balance sheet financing over here, companies want this classification. They want the government to classify their lease as an operating lease so that they can keep the asset and the corresponding debt off of their balance sheet and then keep those solvency ratios low, as we showed before. Well, the government, on the other hand, will grant companies this classification of an operating lease as long as the lease doesn't meet one of these 4 criteria. And if it meets one of these 4 criteria, then it has to be classified as a capital lease, and we'll go over the implications of what happens when a lease is classified as a capital lease. But for now, let's just go over the criteria for when it has to be classified as a capital lease or a financing lease. Now, this criteria can change year to year, textbook to textbook, so make sure that you have the correct updated criteria for your specific textbook that you are using. But as of now, this is what the criteria is. So let's go over one by one. So number 1, transfer of the asset goes to the lessee at the end of the lease. So if at the end of the lessee gets the asset, then it has to be classified as a capital lease. And that makes sense because it's like the lessee then owns the asset. They're not actually renting it for a short term. Second criteria, the lessee can purchase the asset below the market value at the end of the lease. If that happens, you have to classify it as a capital or financing lease. Number 3, if the lease term is greater than 75% of the asset useful life, then you have to classify it as a capital lease as well. That makes sense. So for example, if an asset has a useful life of 10 years and you lease it for 8 years, well, then it's not a short-term rental. You're basically leasing the asset for 80% of its useful life, 8 years out of 10 years, which is greater than 75% of the asset useful life. So if that happens, we have to classify it as a capital lease. And then number 4, if the present value of the lease payments is greater than 90% of the asset market value at the beginning of the lease, you have to classify it as a capital lease. Because if that happens, then that means that the asset is not being partially amortized. It's being very close to fully amortized. If you're amortizing greater than 90% of that asset value, then when you return the asset to the lessor, the salvage value is going to be close to 0. It's going to be fully amortized. It's not partially amortized. So you can't classify it as an operating lease. It has to be classified as a capital lease. So unlike an operating lease, which we classified as quote-unquote a legitimate lease, I like to think of a capital or a financing lease as a fake lease, because we're not really leasing the asset on a short-term basis and we're not just partially amortizing it. These criteria here take the characteristics of someone who basically owns the asset. And if one of these criteria are met, remember, only one of them has to be met, not all 4. If one of them is met, the government says you have to classify the lease as a capital or a financing lease, and companies and lessees don't want this classification. And the reason why they don't want it is because they lose this ability here to keep the asset off the balance sheet. And more specifically, what happens on the balance sheet if a lease is classified as a capital lease is the present value of the lease payments has to go under the assets on the balance sheet and under the debt. So notice how the left side and the right side are both increasing by the present value of the lease payments on the balance sheet. And the reason why this happens is, if you remember, when we were buying an asset with debt, we would take on debt, so that would increase the right side, and then we were taking that debt, buying the asset, and that was increasing the left side. Well, if a lease is classified as a capital lease, then the government says it's like the leasee basically owns the asset if it's hitting one of those criteria that we went over before. And if the leasee is pretty much owning the asset, then they have to present the balance sheet in the same way. Hence why those present value of lease payments goes under both the left side and the right side of the balance sheet. And as we showed before, when you increase both the debt and the assets on a balance sheet, then the solvency ratios go down. And the balance sheet looks a little bit more unhealthy. Hence why companies don't want this classification. So the way I like to look at operating and capital leases is like a battle between a company and the government. Companies want to have this classification of their leases because, again, it allows them to keep the asset off the balance sheet and the corresponding debt. And the government says, well, that's fine. You can keep it. We can classify it as an operating lease as long as it doesn't hit the criteria for a capital lease. But if it does hit the criteria for a capital lease, then you have to put the present value of the lease payments under the assets part of the balance sheet and under the debt. So it's like a battle. Companies want this while the government stays impartial. They say you can have this as long as the criteria for a capital lease is not met. So let's do a quick summary of what we went over. So if a company wants access to an asset, two options. They can lease it or they can buy it. If they buy it, then the asset has to go on the balance sheet. And usually when you're debating of whether to buy or lease an asset, it's usually pretty expensive. So if a company does buy it, they'll also be taking on some debt to buy it. So that will have to go on the balance sheet as well. Now, instead of buying it, you can lease it. But leasing it falls into one of two categories. It's either an operating lease, and if it's an operating lease, then you can keep the asset off the balance sheet, and all you have to put is the lease expense on the income statement, as long as the asset is being used for business purposes. But if there are certain criteria met for a capital lease, then it has to be classified as a capital or a financing lease. And then similarly to like when you're buying the asset and the corresponding debt has to go on the balance sheet. More specifically, it's the present value of the lease payments that goes under the assets portion and under the debt portion. Yo, what's up guys? Thanks for checking out my channel. Hopefully you got some value from the video you just watched. If you did get some value, big favor to ask you, please like this video and subscribe to the channel. Any questions, any recommendations on things you'd like to see, please leave it in the comments section. Also check out the description box below for links to material and content related to the video you just watched. Peace out.